What's good, people? Happy Sunday. So I want to show y'all my open positions heading into next week. So guys, even if you don't trade full-time like I do, you trade part-time, whatever the case may be, treat your trading like a business. You guys know I really love to trade credit spreads. One of the reasons I like to trade credit spreads is that unlike buying a naked option, you know your max potential profit. So some people don't like that. They don't like having, a capped profit potential. But from a business standpoint, guys, I actually kind of like that. So what my kind of thought process is, as we get towards, Thursday or Friday, I like to start placing positions for the following week. Now, it doesn't have to be the following week's expiration, but as we get to the end of the week, I like to start putting on positions that can put me in a position, guys, to come into a week with a good looking profit potential. And a lot of times when I do it right and I get some good positions, of course, if the market, is working in my favor, I can kind of, be in a position like I am right now where I don't necessarily need to look for more trades this week. I don't need to get more risk on, rather manage the positions I have open. So with the credit spreads, guys, from a business standpoint, I kind of look at it almost like accounts receivable. If that makes sense. So heading into this week, guys, max potential profit between the couple of positions I have on is just about $7,300. And again, that's all relative as far as, position size, account size, but I'm content with that. So I'm not necessarily going to come into this week, with my own trading or really with the group here, looking for a bunch of opportunity. More so, guys, if the market kind of does what I need it to do, we'll be in good shape here, and it's more so just about managing those open positions. So what I got here, guys, is, and I held these over the weekend, call credit spread here on Goldman Sachs. I've got an iron condor on Amazon, and then I have 2 sets of put credit spreads on Google. So I like to work from my little spreadsheet. What I'll do is I'll post up a screenshot at some point in this video of the orders from Thinkorswim. But between these between these 4 positions, about $7,300 of max potential profit. Of course, that's assuming I let them expire worthless. If I can get 6,500 of that 73, I'm going to be happy with that. So with Goldman Sachs, we got max potential profit of 1,600 on a call credit spread, which I'll show you guys. I closed a couple positions on Goldman call credit spreads as well on Friday. With Amazon, looking at about 2,600 between the iron condor there. And then here on Google, guys, about 3,100. So accounts receivable. I kind of planted those seeds last week, so to say. Puts me in a good position this week, of course, if the market, does what we need it to do here, to not really have to look for much more. So show you guys the positions here on Google. You can see the 2 put credit spreads. We got one out here, guys, at $13.50. Now I got that one pretty early in the session on Friday. You guys and girls in the group saw that. And then the second one I got a little bit later in the afternoon was another put credit spread, selling the 1407.5 and buying the 1402.5. So those are the put credit spreads there, guys, on Google. On Amazon, this kind of turned into an iron condor. It started with a put credit spread all the way out here at 2,800, and then I went and sold some calls out here, guys. So actually 2 sets of call credit spreads, kind of making a awkward little iron condor, but we got 1 call credit spread selling the 3,300 calls, buying the 3,305s, and then we got another one selling the 3,310s and the 3,315s. So that's that with Amazon. And then the last open position here on Goldman is actually a call credit spread. And you can see here, guys, we've got the 205 calls that we sold, and we bought the 207.5s. So let's kind of jump into my thought process here. And always, guys, got to start with the market. So remember, and I know I repeat this every video, but it's super important. The market, guys, does one of 2 things. Whether we're in an uptrend, a downtrend, or a really choppy-ass market, such as the one we've seen lately, we do one of 2 things. We move away from the 21 period EMA, and we move back to it. We do this in an uptrend, right? And the move back to the 21, guys, is just known as the reversion to the mean, right? The return to the average price. So we do that in an uptrend. We do that, guys, in an environment just as volatile as the coronavirus dump. We do that to the downside. We move away from the 21, and then we move back to it. And we also do it in a choppy-ass market like the one we're seeing right now. We move away from the 21, and we move back to it, and we move away, back and forth. You guys get it, but I'm going to keep repeating that in every video. Super important. So, at the moment, guys, Last week we kind of see the market pushing further and further away from the 21 there, but we begin to hold up at some important support levels. More importantly, guys, we had a little checklist here in the focus trades group of things that we wanted to see in the market, not just chart setups, but a little bit more important, things that we wanted to see to get confirmation that potentially we're going to hold up here at support, and over the next couple of days into next week can start making a move back towards the 21. The first thing, guys, is selling volume. We're not going to make a return back to the 21 if we continue to see big above average selling volume. Now, I'm not even necessarily looking for big buying volume. More so just an absence of selling volume. In an absence of selling volume, the market naturally wants to move back to the upside. So as you can see, guys, Wednesday, Thursday, Friday, we lost all the big selling. So looking like things are drying up there. You can look at that on the Qs, Amazon, Apple, etc. The second thing on our checklist was volatility. We don't have a good shot of making a move back up to the 21 if the volatility index is starting to spike like crazy here. And you can see, guys, over the last couple of days, still doing nothing. That works in our favor. We don't necessarily need volatility to dive. It's just as long as it continues to kind of chop around and not be too much of a presence, we've got a good chance of making a move back towards a mean. And then, you guys know I love the squeeze setup. So for those of y'all on Thinkorswim, you can get the Ttm Squeeze Indicator, which is built in here. And what I like here, guys, with the squeeze indicator is the histogram down here at the bottom, which is basically like a momentum reading. And if you guys are familiar with the squeeze, I'll explain it really briefly for everybody else who isn't. Plain and simple. Red bars mean bearish momentum. Energy is being released to the downside. So when the market is pulling back, guys, we want to be careful about getting too aggressive with bounces until we can see all that bearish momentum starting to dry up, which happens when the red bars turn to yellow. That's when we're losing that bearish momentum. So check this out. Now, it first started on the lower time frames, the 30-minute, the hour, the 2-hour, the 4-hour. All those red bars started to turn to yellow. That's a sign that we're losing bearish momentum. And then they actually started to turn into light blue, which means we're starting to build bullish momentum. That's what we're looking for. But then even here, guys, on the daily chart, check it out. For the first time here since the market started rolling over on Friday, we got our first yellow bar here on the daily chart. For the SPY, take a look here at the Qs. Got our first yellow bar there. You can see leading names like Amazon starting to show signs of losing that bearish momentum. Names like, let's say, Big Apple here, starting to show signs of losing that bearish momentum. So that was our little checklist in the group, guys, for what we wanted to see to get some confirmation that potentially we can make a move back to the 21, maybe even a little bit higher over the next few days. So as our little checklist, started kind of firing off there on Friday, that's what gave me the confidence to jump into something like Google here, where just like the market, I'm looking for Google to potentially start making a move back towards its 21. So as the big picture starts to potentially confirm that, we're putting on the put credit spreads. Selling call puts at 1407 and at 1380. Simply looking to collect some put premium as we move back to the 21. For Amazon, this one more so, guys, we just got a big old condor right now. So on the put side, and these both expire, or all these positions rather expire, this coming Friday. On Amazon, we sold the puts down there at 2800, and then you got a couple of call spreads up there, guys, with the lowest one being 3300. So essentially, we make money this week on that if Amazon kind of stays within this range right here. So the put side is getting very close to max profit, and then you can manage the call side. And then with Goldman Sachs, guys, this is actually technically a short position. What I'm loving in this environment is taking advantage of premiums as they begin to spike. So on Thursday, as Goldman's ripping towards the 21 here, I'm putting on a couple different sets of call credit spreads. I'm selling calls at 200, at 205, at 210. I had one that expired on Friday and two that expire this coming Friday. Beautiful dump into the open, down about 2.5% or so. So I locked up all of those, but I got that one left, guys, up there at 205 that expires this Friday. So looking to kind of collect some call premium up here. We locked in some good gains. Now it makes a good bounce back here on Friday, but nonetheless, we got about, call it $11 a cushion. Average move right now for Goldman, guys, is about $6. Those calls are going to lose premium pretty quickly, right? Pretty damn far out the money. So I think we'll be in good shape on that one. But that's it, guys. Just kind of really focusing on the structure of the market. And for me, the rules don't change. uptrend, downtrend, choppy trend. We move back and forth from the 21. So what I've been doing, what I've been trying to teach in the group lately, is just take advantage of this simple structure. As we move back to the 21, get out of the long positions and get ready to potentially short the market back down, buying puts or selling calls. As we get too extended to the downside, look at the checklist. Volatility going down, selling volume disappearing, etc., etc. Look to play the move back to the 21. And then again, you lock your gains as we get close, and you continue to do so. Hopefully this video helps, guys. If you haven't already, go ahead and subscribe, and I'll keep you guys posted, win or lose, on how those positions go there. So I hope you guys have a good week. You can check us out at focustrades.com and come trade live with us every day, and I will be talking to you all soon. Peace out.